Welcome to Taxbytes for Expats, the top tax tips you want to know as an expat. The podcast is here to help answer the common queries and concerns expats have when moving to or from Ireland. Complex taxes explained simply. We'll focus on the Irish and international tax issues to be aware of to ensure you save time, money, and stress.
Avoid the hassle of dealing with your bank and transfer online, by app or over the phone or Currencies Direct today. Keep listening for an exclusive offer for Taxbytes for Expats listeners, and thanks to Currencies Direct for their support of this podcast. Hi everyone, welcome to this episode of Taxbytes for Expats, and I'm particularly excited about this episode because many of our clients will know that we have recently expanded our offering to partner with some excellent UK tax advisors. And Nicola Goldsmith, one of our UK partner network, is with us today. And she's going to talk to us about many of the topical UK tax issues that affect our clients. Nicola has a very illustrious career in tax. She's been working in it since well before the turn of the century, as she likes to put it. And she has nearly 3 decades of experience, with more than 20 of those focused specifically on cross-border UK tax issues. She works with private clients through every stage of life, from the big milestones that they face to the more delicate questions around passing on wealth. And she has a real talent for turning complex tax puzzles into something that's much more manageable and human. The key thing to note here is that Nicola approaches tax the same way we do on this podcast. It's about problem solving, not spreadsheets, and helping people make better decisions with confidence. Nicola, thank you so much for coming on. I know you're very busy and we really appreciate you taking the time to talk with us today.
Yeah, it's my pleasure. Thank you very much for having me.
So I would love to talk a little bit more about your career in tax. I'd specifically like us to kick off with a question that speaks to the heart of why tax? What drew you to it? And what do you wish more people understood about tax?
I couldn't get a job after university.
That's usually a good reason.
Yep. I didn't want to be a lawyer. I've got a law degree. And I ended up working for the Inland Revenue as the lowest grade, where I had a very good grounding actually, but I didn't know much about tax. I was very good at filing. And then I took my knowledge off to work for a proper accountant, where I realised I knew really nothing about tax after a few years. But yeah, I actually realised very quickly I knew nothing about tax. And then I just got into it from there and did my exams, had some really good employers and got into cross-border advisory quite quickly. And I enjoy it. It's problem solving. It's taking real people's problems and trying to solve those within the law. I mean, you can't always give everyone no tax, or you can, but they'd have to move, basically, out of the UK. And obviously, children, it's not always possible. So you try and work within the constraints of what you've got. So it's like putting together puzzles. And of course, everyone's different. Their family circumstances are different. What they want are different. How they want to pass assets on or keep assets. People often like to keep control of assets. So they don't actually want to be gifting them. So you try and come up with creative ways to allow that to happen. But all obviously still perfectly within the law, to try and minimise overall tax burdens, whether it's lifetime taxes, taxes on death, taxes on gifting or whatever. Mm-hmm. And then, of course, chuck in a bit of cross-border, because, of course, the global village, people have been buying properties in Spain for over 50 years. Then you get the Francophiles moving to France. The British got a huge amount of people move all over. The diaspora is massive. I'm probably not as big as the Philippines or the Irish, for example, but it's pretty big. You've got people moving to Australia, New Zealand, and all of these different issues inheriting from different countries into different countries. And it just makes it quite fascinating, really. What do I wish more people would know about tax? I think I wish tax was actually taught as a subject at school. Agree. And people understood, what you're paying tax for and how and why, and what it's all about, because it does have a use. It does. I mean, taxes are what has made a lot of people give up smoking, including me.
Could be used to change behaviour. Mm-hmm.
Yeah, so tax can be used to change behaviour. It can be used to raise revenue. It can be used to do all sorts of things. Some for the power of good, some possibly not. But that depends on your perspective, your point of view, and which side of the social divide you're on. But some countries don't have inheritance tax, for example, and there are quite a few of those.
The funny thing is as well is that, like, when you work with a client, you don't, well, personally speaking, you don't really have time to debate the moral rights and wrong of the code and how it applies. It's much more based around their situation. And I know one of the comments that you've made is, tax is about problem solving and it's not necessarily about maths. Can you explain a little bit more with us about what you mean by that? And particularly for a client who might feel a little bit overwhelmed by the whole concept of having to take advice from a professional.
I'm rubbish at maths. I really am. I didn't do A-level maths. I gave that up very, very quickly when I realised how complex and difficult it was and did history instead. But tax is all about what you've got and what's due and where. It's very difficult to explain. It's not necessarily about the amount you pay. Sometimes it's about percentage. I mean, look at Warren Buffett. He pays a lower percentage rate of tax than his cleaner. He never claimed he paid less tax than his cleaner. He just said he paid a lower tax rate than his cleaner. Headline rates in different countries seem scary and frightening. People move to France and they look at 45% tax and they're like, and then when you actually get into it, it's not that high necessarily or that complex. It's just a different system. So, yeah, and here in the UK, you get to that £100,000 threshold, and suddenly for the next, sort of £25,000, you're actually paying a marginal tax rate of 67%, which is, because it's and steps. It used to be when we had stamp duty a few years ago. It's changed now, and now it's progressive, which means that you get to a certain level and then the tax rate goes up. But it's not the tax rate on everything goes up; it's just the tax rate on that block goes up. But it used to be a step rate. So if it was below a certain percentage, you pay nothing. If it was above that percentage, you pay 5% on the lot, which is quite a hefty chunk. And that's a big step up. That's why it's called a step. And tax is unnecessarily complicated. There are some countries out there with flat rates where it's literally 10 or 15 or 20%. And then there are countries like the UK where the latest budget, which is the tax bill. So bearing in mind the UK tax bill, you have to renew income tax every year. It's an annual tax. So if Parliament doesn't pass the legislation to allow it to be in place, nobody pays income tax.
That'd be a nice year.
Because it was raised as an annual tax to pay for the Napoleonic Wars.
Okay.
So, but the latest finance bill, based on the last budget we had, which bearing in mind wasn't exactly, she didn't talk for hours and hours and hours. She talked for a long time, but, that's 536 pages. It's one of the longest budget bills we've had for many years. Mm-hmm. So the legislation for the UK is massive and complex, and there are different bits that are very weird. So the rate for business property for capital gains tax is like you have to have been, it's got to be 80% trading business, but for inheritance tax, it's only got to be a 50% trading business. It's they kind of clash and don't fit in nicely sometimes and stuff, and it's all just weird contradictions.
And I think that's often where I suppose so much time can be spent from an advisory perspective, navigating the circumstances of the client and then the nuances of how complex legislation, particularly if you're advising two parties who are entering into the same transaction, how it impacts them.
I don't usually do that sort of thing because that's business, but normally it's families and it's trying to find the lowest way tax through for everyone.
Yeah.
Not necessarily, because sometimes, for example, it used to be that before we had the transferable nil rate ban, you had to basically pick to benefit your children or your spouse on your death. And now we've got a transferable nil rate ban. It's a bit better, but that means that's the bit that's not taxed, that's passes between. So when you die, there's a £325,000 amount that's not taxed. It's not exempt. It's taxed at 0%.
Right.
And there's a reason for that. But so when the first one died, it used to go poof. So if you gave it to your spouse, if you gave the assets to your spouse, no one paid tax, which is fantastic. But then your nil rate band was never used, and that changed in, I think, about 2007. And now it's changed so that when you die, if you don't use it, then your spouse can use it when they die.
I want to talk a little bit about perhaps a cohort of people who might be interested in a podcast like this. And that's going to be somebody who is leaving the UK or perhaps planning a move there. So if you will, for us, can you step through, what are the first or the key headline tax considerations for somebody who is, let's use an example, leaving the UK in a given 12-month period?
I always say, as soon as you know, start taking advice, because the changing country is a fantastic opportunity to do all sorts of things, to rebase assets, to work out things. It might be possible, because the UK has got the weirdest tax year.
I agree. It's the strangest one.
There is a proper reason behind that. It's all to do with the quarter days and then the change to the Gregorian calendar and stuff like that. But so, come on, New Zealand starts on April the 1st. I mean, somebody definitely had a sense of humour there.
Mm-hmm. Yes, they did. Good point.
But because of our tax year being different from most countries, then it's possible to, for example, maybe create a small period of non-residence anywhere that you can use to sell assets tax-free or realise different forms of income tax-free. So there are opportunities in whichever direction you're moving to create these sort of windows of opportunity to, maximise the rules to your benefit, because it's all perfectly legitimate. There is nothing wrong with that. It is perfectly legal to not be resident anywhere. It's just really difficult from a practical point of view. For example, if you wanted to get finance, you've got no residence, then the bank would be going, no. So there's things like that. I always look at all of their income streams so that we can work out what's taxable where, look at where they're going, double tax treaty, how that's going to work. If we're looking at selling a business, then leaving the UK is a fantastic opportunity. The UK has got some really weird tax rules for capital gains, and they generally don't tax non-residents on capital gains. So I have helped many people leave the UK, go somewhere where there's no tax on capital gains, sell their business for millions, and realise that and completely walk away with all of the money. And I have to be honest, if I was Chancellor, it'd be one of the first things I'd change. But although I'm not going to say anything about, but there possibly being vacancies soon, but this is one of the things that we can look at.
And now a quick word on our episode sponsor, Currencies Direct. If you're looking for a fast, easy way to transfer money to or from Ireland without the hassle and cost of dealing with your bank, keep it simple with Currencies Direct. Whether you're buying property or require regular currency transfers, Currencies Direct can help you save money. As a special offer for our listeners, when you use the link in the show notes and quote Expat Taxes when registering with Currencies Direct, you'll receive a €50 one-for-all or Amazon voucher when you transfer €5,000 or more in your first 6 months with Currencies Direct. Registration is quick and easy, and you decide how you transfer 24/7 via their online money transfer service, over the phone with one of their friendly experts, or by using their handy mobile app. Check the show notes or head to currenciesdirect.com to register. And thanks to Currencies Direct for the support of this podcast. And the key thing that comes through, and it time and time comes up when we have conversations like this with people we're interviewing for the podcast, is the planning bit. So what you've just described there is somebody who has accumulated wealth and has a plan. The first thing they need to do is have the conversation, so that they can kind of determine the details as they relate to them. What time frame would you like to see people reach out to you when they are planning to leave the UK? When do you want the cutoff point to be for a conversation?
I've helped someone leave the UK when they came to see me at the end of February, and we got them out by the end of the tax year.
Okay, yeah.
5th of April. So I've done it that quickly. It does require a bit of planning, but a year is good. A year to 6 months before and also the date. Organising the date to leave the UK or arrive in the UK makes a difference. So under the new foreign income and gains regime, which is also the name of FIG regime, which is also affecting the new inheritance tax rules for non-domiciles. It's still called the FIG regime, which follows on for the actual domicile rules. If you are resident in the UK for 10 consecutive years or 10 out of the previous 20 tax years, then you are what we call a long-term resident. But you just have to be resident for a single day in a single tax year for that year to count. So if you arrive on the 1st of April 2026, which next year, you're resident in the UK 25-26 tax year, even if it's for only 5 days. And that counts as a year for the long-term residence rules. So you can actually arrive in the UK on the 1st of April 2026, leave the UK on the 10th of April 35, and you would still, even though you've been in the UK for barely 8-9 years, you're still going to count for the full 10.
And what's the benefit of that regime? Because I'm keen to kind of talk about the FIG regime. I mean, that was one of the big changes we saw to the legislation, watching from afar in recent years.
Oh, it's massive. It's absolutely massive. So the FIG regime, basically, if you're arriving in the UK and you've been non-UK resident for 10 years, then for the first 4 years, you can elect, you have to claim the relief. Your foreign income gains is not taxed. Can be moved in and out of the UK, but it's not taxed. However, you lose your personal allowance, you lose the annual exemption for capital gains tax, and you have to declare all of the income and gains, and then claim the relief, or what relief you're claiming. You can claim the relief on any sum and all of the income or gains. It's entirely up to you. But as soon as you start claiming, you're going to lose those allowances. So not always the best idea, actually, but it will work. And this replaces the non-domicile regime. So domiciles are I love domicile. It was my favourite subject. And then Rachel Reeves stole it from me. And I loved advising on it because it was related to where you're belonging, where you belong. And the thing is, if you were a UK national, born in the UK or had a UK national resident father, and it usually came through the patriarchy, through the father, then what happened was you could go away, live, I don't know, in Australia or whatever for 40 years, and then come back and the UK would still go, well, it sounds like you've never been gone. We'll tax you anyway. But now people who've been out of the UK for a long time actually can benefit from this in a way that they never used to be able to. So they are actually the winners out of this regime. The losers are the people who used to come here and be able to claim the non-dom regime on their income gains, so they'd not pay tax on their income, the remittance basis. They would only be taxed if they remitted foreign income gains into the UK. They're actually a winner for the first 4 years because that never used to apply. They used to have to claim this basis, and if they remitted income and gains, you had to pay tax on it. But after 7 years, you had to start paying quite high charges just for the privilege of using it. And then from an inheritance tax point of view, again, people who originally came from the UK went away and then came back. If they haven't been here for 10 years, they're non-UK assets. And anyone who's not been here for 10 years, their non-UK assets are not subject to UK inheritance tax. It's huge.
This is subject. So previous to that, the charge to inheritance tax was with reference to domicile?
Your domicile. So domicile's connectedness. So my father is a British national, lived in the UK all his life. He was married to my mother at the date of when I was born, so I'm an English domicile, because you're domiciled in England and Wales, or in Scotland, or in Northern Ireland for our purposes. And obviously each country's got slightly different rules. And domicile, it dictates your private international law, so the law that affects it's actually not a tax concept, it's borrowed from international law. And it dictates, divorce, marriage, all sorts of things like that. So it's got a lot to do with that. But it was borrowed by the tax people to connect people back to the UK. And it was very difficult to shift your domicile. You had to leave the UK and intend never to come back, really. One chap very famously lived in Australia for 40 years, kept calling the UK home, never set foot in the UK after 40 years after he left the UK. And the UK still found him to be UK domiciled at his date of death.
Courts.
Richard Burton wanted his ashes scattered in Wales, even though he died in Switzerland, and he hadn't been really to live in Wales for a very long time. And again, that was held to be sufficient for him to be Welsh domiciled at his date of death. And I suspect Tom Jones will definitely be Welsh
Mm-hmm.
domicile
Mm-hmm.
under UK law. But if he hasn't lived in the UK for 10 years, then only his UK assets would be subject to.
So, okay, that's a very good, exactly, it's a shift.
Under the new regime. So it makes a huge difference.
So if you are residing outside of the UK on an ongoing basis, using the example of your 40 years in Australia,
Yeah.
there's a big shift in exposure to inheritance tax for somebody like that.
Oh, gosh, yes. And especially as Australia doesn't have inheritance tax. So it's a massive shift. And even if you came back, before if you came back, you were a formally domiciled resident, and the inheritance tax would come back after a year, or almost straight away, depending on how the revenue felt and the courts felt your domicile had shifted. Yeah, you really had to sever ties with the UK as far as possible, and of course, people didn't, because people going abroad to Europe, they'd often retain the family home because they didn't want to sell it. The family, kids come back for Christmas, all that sort of thing. So, it was very hard to actually become non-domicile if you were a UK national leaving. But correspondingly, it was also quite hard, although the revenue tried, for people to come and live here and become UK domiciled.
Mm-hmm. That pendulum has to swing both directions. And obviously, in an Irish context, we have borrowed from the UK many of the concepts around domicile. So we have very similar concepts here, and we would lean quite heavily on some of the UK case law.
But you've also kept ordinary residence, which we haven't.
Yes, we do.
So although ordinary residence still applies to national insurance and social security law, because, hey, why wouldn't it? Residence for tax purposes is different from residence for national insurance purposes.
So you have a 3-year ordinary residency rule for social insurance?
Yep. And it's different for stamp duty.
Okay. For us, the ordinary residence still enshrined quite in law.
That's 3 years, isn't it? It's a 3-year tail, yeah.
So interestingly, opportunities there if you have a 3-year nexus with Ireland, and then you can enter the FIG regime and have a 4-year benefit. There is perhaps,
I know.
This is the type of planning that goes on. You know what I mean? And sometimes I think what you said earlier, I really, really like. You said, you can be non-resident in a location or in any location. And I find people get quite nervous about that. And the reality is a lot of what this cross-border planning is legitimately, and we have to stress that word, very legitimately.
Absolutely. It is very legitimate. And it's simply using different year ends. You've got a 3-month period where, you can leave the UK. And because the way UK splits the tax year, you can leave the UK at the end of a calendar year and sort your timings out because of these differences. And it is absolutely legitimate. And sometimes it can be as little as a week. It doesn't have to be long. A week can be enough to rebase most of your assets and save a fortune.
Give me the elevator UK tax residency pitch. Now, you might say and laugh and say that's not possible, but in the summarized, because obviously this is where a consultation really kind of, pays for itself, because this is complex stuff. But what is UK tax residency condensed?
It's when it was introduced, it was 105 pages of guidance.
Wow.
Admittedly, about 50 pages of that was for dead people and people who died in year. And I haven't had many of those. But basically, you can be either automatically non-resident if you spend very little time here. So you're either a leaver or an arriver. If you either got connections with the UK lived in the UK for any of the last 3 years or not. If you're a leaver, the more time you spend in the UK, and the more connections you have, the more likely you are to be a UK resident. If you're coming to the UK after a period of non-residence, then you can usually spend longer in the UK without becoming UK resident. If you want to become UK resident, it gives certainty in a way that it never used to. But basically, you're either automatically resident or you can be automatically non-resident. If you're here for over 6 months, you're automatically resident. There are 3 tests. Each test is divided into subtests. That's the complexity.
Understood.
And then if you're not automatically resident or non-resident, you're not automatically the other, then we have a significant ties test. So the more ties you have to the UK, the fewer days you can spend here without being resident. So normally, someone who is seeking to leave the UK halfway through a year, for example, and we do split the year into periods of residence and non-residence in the UK. Not every country does, but we do. then what would happen is you would look at how long they'd spent in the UK, how long they want to spend in the UK, do they have a UK home, did they work in the UK in that year? Because all of those things can make you automatically UK resident for the whole year. But then you can get split year treatment. So if you, for example, in the second year after you've left, so it's not a split year, it's just a whole complete year. If you were in the UK for the more than 90 days in either of the previous 2 years, you've got a tie. If you kept accommodation in the UK and you use it, that's a tie. Your family, minor children, or a spouse who stays in the UK can be a tie. Although there are some weird rules around that, because if I'm resident because you are and you are because I am, you can actually ignore that one completely. And I actually helped someone whose wife and child, all of them spent around 180 days in the UK in 24, 25. And we actually looked at everything, went through all of the rules. And because of that, you could discount that family rule for all of them. None of them were resident in the UK.
Wow, okay.
Which actually turned out to be really good for that particular family.
Mm-hmm.
Because, that made everything quite nice in that respect.
Thanks for listening to Taxbytes for Expats. Please do leave a rating or review wherever you listen to your podcast. And as always, remember to take professional tax advice specific to your personal circumstances before acting or refraining from action in connection with the matters dealt with in this series. The material in this podcast is intended to give general guidance only.